Okay, hello. What's going on, everybody? Can you guys hear me in the YouTube chat before we jump into this analysis? Sound check, audio check, visual check. Okay, what's going on, everybody? Welcome to a Capital Hungry Monday Market Update and Trade Ideas webinar. We're going to be jumping right into it, doing some fundamental and technical analysis across main pairs that we trade: gold, GBP JPY, GBPUSD, EURUSD, USDCAD, US 30 stock market index, while also looking at market sentiment, fundamentals at play, key economic events to focus on, and then marking out some trade ideas across those pairs. So, for those of you who have been confused, basically what we have been seeing happening in the markets is, of course, the tide starting to shift in terms of the market cycle after having an excessive couple of years of increased economic inflation, very low interest rates, and the majority of asset classes being pumped to historical highs or all-time highs when you're looking at the housing markets, commodities such as oil, gold, the stock market, and so forth, real estate, like I said, the housing market. So the reason the majority of these asset classes have been so bullish is primarily because of the conditions that allowed so much investment to come into play, being low prices 2 to 3 years ago, low interest rates, support of the Federal Reserve and their asset purchase program, and rising inflation, which increases the prices of everything within an economy. But now we're starting to see the tide shift as we have very high prices across all of these asset classes, and majority of central banks are looking to become a lot more hawkish in terms of raising interest rates. So what we're seeing is an outflow of liquidity in majority of these asset classes such as gold, oil, even real estate is starting to cool down in North America, and of course global equity markets. So the market is adjusting and pricing in more consecutive inevitable rate hikes to come, especially when we're looking at the example of the Federal Reserve. So the reason for US dollar bulls, equities weakness, gold weakness, and commodities weakness is due to markets pricing in rate hikes to come by central banks, and more importantly looking at the US Federal Reserve rate hikes, as the US dollar is of course the global business currency. So we're still looking to play a bias on the intraday time frames, whether we're looking for day trading or scalping. For gold sells, US dollar strength bias, so potential GU EURUSD sells, UCAD buys, and still looking for some potential equity market sells, but just being cautious of very frequent dead cat bounces we can see occur on the equity markets, as the greedy stock market buyers will try to squeeze out what they can in terms of liquidating positions from better price points. Other than that, we still want to play a Japanese yen bearish bias, as the Bank of Japan has still been more dovish. Majority of central banks, especially since that last IMF meeting that was held April 21st, and then of course the FOMC and such that followed, majority of central banks have been a lot more hawkish. The only one that's really still dovish when you're looking at the main players on the global table there is Japan, where the Bank of Japan is still keeping interest rates in the negative and still keeping their unlimited bond buying program going. So we still want to play some Japanese yen bears when we're looking to play some potential GJ buys and understanding that correlation in play. And of course, Russia and Ukraine tensions are still lingering. So this means in terms of market sentiment, with the fundamental catalyst stated of economic uncertainty and doubt developing as the market is adjusting and pricing in further rate hikes to come, we can see we want to play US dollar strength, but with the Bank of Japan still being dovish, keeping interest rates in the negative, as well as their unlimited bond buying program active, We still want to play Japanese yen weakness and bears, and we want to play equity market bears, just being mindful of some dead cat bounces. Volume and volatility has been relatively healthy. It's not as high as the last few weeks where we had a lot of various fundamental catalysts at play. And as we were winding down, of course, the previous month and starting this new business month, of course, of May. And obviously May started out with those holidays for Asia zone as well as Eurozone as well. So volume and volatility hasn't been the highest, but it's still very favorable for us to play some day trades and potential scalps. Then just some key headlines from today. Fed's Bostic sees 2 to 3 50 basis point rate hikes as baseline. The Feds do want to normalize interest rates back to that 2.5 to 3%. So we will see consecutive 50 basis point rate hikes, which just further adds on to what I'm explaining to you about the market pricing in those rate hikes to come. Hence, we see that dollar strength, weakness in gold, weakness in oil, weakness in equity markets, and so forth. And we're looking to play that sentiment still. Janet Yellen says there's a potential for continued volatility, unevenness of global growth due to war in Ukraine and fight against the COVID-19 pandemic. But it's really due to the fact that the Federal Reserve is now raising rates into a declining, weakening economy, which is going to cause, which the US is pretty much winding down into a recession anyways, after having a very overheating economy coming out of a lockdown phase, which I explained in my Twitter podcast, if you want to go check that out for more detail. So they're just trying to point fingers and blame Ukraine, blame COVID, when it's really their government policies, it's really their central bank actions that made the rich richer, but that's a whole topic for another conversation. And because of US dollar dominance as the world reserve currency and interest rates going up and that uncertainty and doubt developing, we can see crypto getting hit hard as well, with Bitcoin dropping more than 10% back down to 30,000 flat, a very critical level when you're looking at Bitcoin on the higher time frame. And we can see a lot of outflow in majority of asset classes is what I'm really trying to communicate there. So in terms of market sentiment, higher time frames, dollar is still very bullish. We are getting some signs of exhaustion at these intraday highs printed at 104 flat here. But overall, with the markets pricing in more rate hikes to come, very bullish market structure with buyers consistently printing higher highs, only having short-lived pullback phases. Even if we get a pullback to 102.8, more than likely dollar is going to continue chugging to the upside, and we want to play that dollar bullish bias. Japanese yen, for the reasons stated on the higher time frame and intraday time frames, is still very bearish, with potential to come down to these lows at 76 flat, as the Bank of Japan is still very dovish, keeping their unlimited bond buying program active. Volatility index is starting to potentially trade and hold above this 34 key price point of interest. The same time, we have US equities sitting on a very strong demand zone that we might see a potential break below if we see this uncertainty and doubt continue, with the markets further adjusting to these rate hikes to come, and we see US 30 break below that 32,200 price point. I'll show you guys in a minute. Global equities in terms of sentiment, seeing that outflow. So just showing you guys the technical confirmations of those fundamental catalysts stated, and you're going to see how we can use those correlations to our advantage. So now, when we're looking at gold here, gold on the higher time frames, ever since the IMF meeting, April 21st here, has been a lot more bearish as the market has been pricing in more aggressive rate hikes to come, which is a fundamental bearish factor on gold. You can see FOMC had a very short-lived buy bounce that was really just to go collect some more sell-side liquidity and sell orders as we continue to drive down lower, revisiting these previous lows at 1855. So when we're even coming to the higher time frames here, like the daily, you can see ever since that period in time, April 21st, sellers have been in control, consistently printing lower lows, which much more aggressive bearish price action, and only having these very short-lived pullback phases That's just sellers liquidating positions at the lows, buyers jumping in to provide that exit liquidity, creating a short-lived pullback to collect more sell orders before driving down even deeper. You can see this previous daily candle has now engulfed almost 4 days of bullish price action there, closing below the previous daily bodies, where if we see continued US dollar strength, we see continued outflow of liquidity in the equity markets, we see continued softness in commodities like oil, we know the market is further adjusting and pricing in those aggressive rate hikes to come, and gold more than likely can easily start driving down into the 1840s and 1830s here, because we're breaking very key price sensitivity area and demand zones while also making much stronger higher time frame bearish market structure here, with sellers of course in control, and the fundamental catalyst being more aggressive rate hikes coming into play, which is a bearish fundamental factor for gold. So on the intraday time frames, we're just sitting at these previous lows, but you can see the way gold behaves. Once you break that significant previous low, give or take a minor pullback, we should just see a continued move to the downside as we're seeing that liquidating of positions there. So 1852, 1855 is our very key make or break area, but nonetheless, even pullbacks to this medium term zone here and price sensitivity area around 1867, I would be looking for sells and sells below 1852 and 1845. We don't have much economic data on the docket. A lot of the Russia and Ukraine tensions have been priced into the markets, and that impact it had on gold as well as commodities like oil has been faded out. Now we're seeing the majority of smart money, market makers, whales, whatever you like to call them, more adjusting to the inevitable aggressive rate hikes to come by the majority of the major players, central banks from around the world. So we have to understand that that's a bearish fundamental factor for a lot of these asset classes, hence the technical bearish market structure we've been seeing from our manual retail trading perspective. So I'm mainly looking for sells on gold. I would only be switching into a buyer bias if we were trading back above the 1876 handle there. Now, GBP JPY. Remember, GBP has been a little bit softer with some more uncertainty coming back to the table with Brexit. A lot of the rate hike expectations we saw with Bank of England being priced in. So we had more of a buy the rumor, sell the news type of play happen here previously. This was the Bank of England sentiment here. But I want to show you guys something very important. We understand that the secondary currency in this quote is of course the Japanese yen, which has been extremely bearish due to the Bank of Japan's dovish sentiment, keeping interest rates in the negative and keeping their unlimited bond buying program going. This price point of interest is a very important fundamental price point of interest. This upside move here is when the Bank of Japan first announced their unlimited bond buying program towards the end of March. If you want to go back test that and Google it yourself, you can see we had this heavy impulsive upside move on GJ and other yen pairs as the yen weakened individually there as the safe haven currency, a pullback to this area double bottom, and a rally to these highs. Now what's important is we had an aggressive pullback phase to the downside exactly to this demand zone again and buy side liquidity zone, and this aggressive upside move was the Bank of Japan interest rate decision. So the dovish Bank of Japan interest rate decision drove us down to the same price point as the Bank of Japan unlimited bond buying program, and the Bank of England rate decision, as well as this liquidity grab today here, has come to the same buy side liquidity zone, failing to break, still respecting higher time frame bullish market structure in this very key demand zone. And when you're coming here and looking at GJ on the higher time frames, it's still extremely bullish, right? We've had huge highs printed. When you're looking at the daily, we've just been a bit of that pullback structure, but this is a very key price sensitivity area we want to keep our eye on, where if we're still trading above here, I'm expecting more buy orders to be collected here, as both fundamentally and technically Japanese yen is individually bearish, and the Bank of England is individually more hawkish, where they're going to be doing more consecutive rate hikes to come. So when you're looking at GBP against the yen, you have more bullish fundamentals and bullish technicals, as long as we don't break below this very, very key demand zone at 160 flat. So I personally can't see any GJ sells in the higher time frame unless we break below 160 flat. Otherwise, we can even see very strong support being created with more failure to break this 160.500 area. So on GJ, even deeper pullbacks to 0.200, breaks above 161, I would just be looking to jump back in buys, as Japanese yen is still bearish, GJ still bullish on the higher time frame. In my opinion, what this downside move we're seeing on GJ here is really just the new monthly period grabbing some liquidity to the downside, which to us as manual retail traders, we observe a wick being created and this liquidity being grabbed here, where I can still see this potential monthly candle even closing a lot weaker bearish or starting to even flip bullish, especially if we get more hawkish remarks from the Bank of England of more rate hikes to come, which would be bullish for the currency, bearish for the UK equities, and especially if the Bank of Japan sticks to their dovish sentiment, keeping interest rates in the negative and their unlimited bond buying program going, and especially on the intraday time frames in terms of technical price points of interest, we're still trading above 160. So I'd be looking for those green box area buys highlighted and continuations to the upside. I would only be switching into a GJ sell bias below 160. Okay. Now, our dollar pairs have been extremely bearish. Obviously, just having more of that inverse correlation of the US dollar, because of course the US dollar is the world reserve currency. I was expecting a deeper pullback on the dollar, but it looks like the sellers are still in play, and we just had this deeper liquidity grab here on GBPUSD from 1.2415 and still failed to break overall structure with a quick snapback below this range here. If we could sweep these highs again and come below key level 236 or break below 23, I would be looking for continued GBPUSD sells, just because of dollar domination as the world reserve currency and business currency, and being so extremely bullish right now as investors and smart money are pricing in more aggressive rate hikes to come, consecutive 50 basis point rate hikes. If dollar continues to trend bullish here, go back to 104 and start to break higher, then we're just going to have continued sells on GU, continued sells on EURUSD breaking back to the downside of this range, and continued upside on USDCAD. So GU and scaling down, I would only be switching into a short-term buy bias if we can notice exhaustion by buyers on the dollar index individually and GU trading above 2415. Otherwise, my main bias is always what I state first. Even if we sweep these highs and fail to break, correlations being continuing to respect bearish market structure, bearish price action still in play with dollar index holding its bulls, and respecting these key levels as we potential break to the downside. No, they're going to do consecutive 50 basis point rate hikes. That's not that trajectory. They don't have to go like the way you said, 25, 50, 75. Doesn't work that way. Same thing with EURUSD. Even if it comes to sweep these previous highs again, I'd still be looking for sells in these areas. Otherwise, holds below 1.057, breaks below 1.0525. I would only be switching to a sell side bias above 1.0645. Higher time frame structure is far too bearish. Dollar index is too bullish. We're seeing that outflow out of risk assets and risk currencies against the dollar especially as well. We're just seeing a bit of consolidation at these lows, but unless we were trading above this candle body high here, I can't even anticipate a deeper pullback phase before seeing more sells. I'm still just anticipating us making our way to the downside, especially if dollar still holds bullish. I'd only jump into EURUSD buys above 1.0654 higher time frame key level. USDCAD, we have both the double advantage of oil exhaustion from the highs, which also weakens the Canadian dollar in the short term, and of course individual dollar strength from a more hawkish Federal Reserve. So deeper pullbacks to 1.29 or just pullbacks to key level 298, I would be looking for potential buys, continuations on USDCAD. We can see the higher time frame here also showing a lot more exhaustion from these previous lows to the left from the start of the year, January. Much more stronger bullish price action, breaking above this price sensitivity area, just looking for minor pullbacks and continuations to the upside on USDCAD, playing that short-term weakness in oil, which has that correlation effect to weaken the Canadian dollar from a fundamental perspective, and more dollar bulls from investors pricing in aggressive rate hikes to come, and US dollar still being your world reserve business currency. Now, equity markets are at a very, very key make or break area. This downside move here was when we had Russia-Ukraine tensions first coming to the table and 25 basis point rate hikes being priced in. This downside move here was the 50 basis point rate hike being priced in and more aggressive rate hikes to come. You can see we're at a very key make or break price sensitivity area of interest right now, with the correlation of seeing individual dollar strength, volatility index potentially trading above 34, very key make or break price point to show a lot more fear, uncertainty, and doubt within US equities. And if this new daily candle just does a pullback to even 32,600 and still fails to break, we could see a lot more liquidating of positions on the equity markets as we're breaking below that price sensitivity area, and of course having more of a bearish market on equities with more inevitable rate hikes to come. So on US 30, with the fear, uncertainty, and doubt developing, 32,600, 32,400, breaks below 32.2, I'd be looking for the sells. I'd only be jumping back in buys if we were to hold above 33K flat and clear out all of that sell side liquidity and show a lot more buy orders collected from that demand zone. But we need to see volatility index failing to break above 34, dollar being more bearish as well. So again, we went through those fundamental fundamental points of interest, the reasons why US dollar is bullish, the reason why equities have been weak, gold weakness, commodities weakness, and so forth, the reason why Japanese yen is still bearish, other tensions and interest points highlighted as well. We went through our market sentiment analysis and individual analysis of dollar, Japanese yen, global equities, and checking out what that tells us about investor behavior from a sentiment point of view. We went through some key notable headlines from the last couple of sessions, a volume and volatility reading, and then did some technical and fundamental analysis across these pairs. This is going to be saved and uploaded so you can rewatch it as you wish. But thanks everybody for watching. Everybody take care. Have a nice day. I'll see you all on Wednesday for our scalping session.